Let's get the read on all of this, too, because I do want to talk about the markets and what's happening today, another triple-digit advance. I don't want to get leery of that, but we've seen this before with the markets running up and then giving all of that up by day's end. But back, Scott Martin, if you don't mind, on this energy situation. I mean, this might be a preview of coming attractions, what's going on in California. And I don't know if the nation is prepared for any of this, given the clean energy push and all of that. But it will come, presumably, at a very, very big price if we have to do a wholesale revamp of our grid.
Yes, and doesn't it always, Neil? But somehow, I'll tell you, if you look back in history, last 5, 10, 15 years, 25, 30 years ago, Neil, when I was a very small wee one in the crib, they were talking about running out of oil, running out of water.
That's right.
So, not to belittle the point, my friend, but we do somehow, as a human nature or human force, get through this. It does feel terrible this time, like it did the other times. We will come out on top somehow. I don't know exactly how. I don't know how much pain, to use that word, we have to go through to get there. But you're right. It's a very inopportune time. Certainly the message from the government in D.C. is not very, say, at least responsible when it comes to all the changes they want to make in a snap when we don't have the infrastructure to do that. So the reality is it's going to hurt a lot of folks. But there is some progress with the pain. And I think we have to just try to work through this together if we can, even though the administration is certainly kind of foreign to doing that.
You know, the markets are weird beasts, and you've been covering it for a long time here. You know, oil now is in and out of the lowest levels since we had back in January, that hinting of a slowdown or fears of a slowdown in trading, respectively, that way. We're celebrating also the U.S. trade deficit today, sinking about 12.5%. That was a 9-month low. If you think about it, it was really built on just this idea that right now export growth isn't what it was. Imports are very, very pricey. So it is reflective of just a slowdown. And I'm just wondering how you see that playing out and why the markets might welcome that in this environment where they're afraid of rate increases.
Bingo. That's exactly it. I mean, that's really what's going on here, Neil. It's darkest before dawn period right now. I mean, everybody, if you look at the experts, quote unquote, not myself included, everybody's turning tail on the markets again. Forget the rally we had the previous 2 months. The reality is everybody is coming to this forefront now where things are going to be terrible again. It's another bear market coming. And I just don't believe it. I think the data now, Neil, you mentioned the trade deficit numbers, the energy numbers behind the scenes are coming down explicitly. So are other commodity figures. There's some good things going on behind the scenes that the market just isn't paying attention to. And I'm telling you, once the Fed gets through this, and I don't know when exactly that is, I'm hoping November is the last rate hike we see this year, at least until they back off and let some of the data kind of come in and react to the hiking they've done. I think this market comes back faster than Richard Simmons because of the fact that so many people have bailed on this market. They've thrown in the towel. They've told investors, they've told analysts have told us that the market is dropping another 10, 15, 20%, whatever your number is. I think that's the time when you have to go in here and start buying stocks because of the fact everybody is so bearish.
You know, the strong dollar works a couple of different ways, right? I mean, in this trade report, because it was so strong, it certainly made imports cheaper coming into this country. But there wasn't a great deal of demand worldwide for what we make. So we did benefit a little bit there, and you herald that. The oil thing is another issue here. But back to the dollar, if you think about it, for international companies, that's not a good thing. A lot of their strong sales abroad and earnings, when translated back in dollars, they're getting fewer dollars. So it's sort of like a double-edged sword, right?
Yeah, maybe even triple-edged, because I would add this. I mean, currencies are so fun. We've had massive movements, by the way, Neil, year-to-date in currency. I mean, if you look at currency history, whether it's the euro, the yen, the renminbi in China, the U.S. dollar, the Canadian loonie, I mean, we have had a massive move in the currency markets this year. So that's strange. I mean, that's kind of an outlier to be fair. But here's the other kind of third edge of that sword, Neil, if I may. Currency, bonds that are denominated in, say, U.S. currency, all of a sudden get bid, meaning interest gets in the buying of those bonds because they're denominated, my friend, in U.S. currency. So as we talk about the markets and their, say, sensitivity to interest rates, think about it. When folks come in internationally and buy things denominated in dollars, which are the U.S. treasuries, they go up in price, down in yield. That's something that the market wants to see as well that could be a boon from the strong currency.
All right, Scott Martin, thank you very, very much for that. We're showing you the British pound right